So, ladies and gentlemen, I would now like to give a warm welcome to the Web TV audience that has just joined us to follow the Swiss National Bank IMF high-level conference on the past, the present, and the future of the international monetary system. And I hope you can hear and see us clearly. We will be broadcasting 2 sessions of our conference live. The first session on the past of the international monetary system starts now and should finish at 10:30 a.m. The second broadcasted session on the future of the international monetary system starts at 2 p.m. and lasts until 3:15 p.m. So, without further ado, I would like to open the conference. I look forward to a lively discussion and an open exchange of views. Barry, I invite you and your 4 speakers to the first panel to come forward. Thank you very much for your attention. Thank you.
Good morning, ladies and gentlemen. Let me start by thanking Thomas Jordan and Christine Lagarde and everyone from the SNB and the IMF who has helped organize this meeting. I was interested to hear that the Swiss National Bank is still healthily skeptical about central bank digital currencies, but it's all in terms of web TV. So management has given us strict marching orders, 15 minutes for the moderator starting now, and 10 minutes for each of the panelists. The panelists are organized and disciplined, and I'm sure they'll keep within their time. Not so sure about the moderator. So how has the international monetary system evolved since Bretton Woods? That's a very large topic, and I will attempt to impose some structure on the discussion by distinguishing 2 views. One, which I will call the Harvard view, is that there's a high degree of persistence in the structure of the system, which remains dollar-based and US-led to a remarkable extent. Here I'm referring to the work of Geeta Gopinath, who's with us, supplemented by the work of Emmanuel Fari, Jeremy Stein, and others. I will call the alternative the Berkeley view, in that, which is that the system is evolving away from the US and the dollar toward a multipolar world in which several consequential international and reserve currencies coexist. Other countries no longer rely exclusively or even mainly on the United States for international liquidity, and governance of the system is a collective endeavor. Here I'm self-referentially referring to my own work, but also to that of my Berkeley colleagues, Maury Obsfeld and Pierre-Olivier Gourenshaw. Truth be told, the 2 views tend to shade into one another, nor are they rigidly associated with Harvard and Berkeley. Still, I think this is a useful working distinction, and I will maintain it for purposes of this introductory presentation. The Harvard view, as I see it, is fundamentally empirical. Its point of departure is that the observation that some 60% of identified global foreign exchange reserves still take the form of dollars. More than 60% of the foreign currency liabilities and assets of banks are in dollars. And the share of world trade invoiced in dollars far exceeds the share of the United States in global imports and exports. So Geeta and her colleagues have documented these observations in a variety of publications and drawn out their implications. They have shown that the dollar exchange rate matters more than the effective exchange rate in price pass-through and trade elasticity regressions for a variety of different countries. They show, in addition, that U.S. monetary policy induced dollar fluctuations are pass through into the import prices of other countries, but not so, at least to the same extent, monetary policy-induced fluctuations in other exchange rates, as if import prices are sticky in dollars. They show that the strength of the dollar is a predictor of global inflation because changes in the dollar exchange rate are translated roughly 1-for-1 into changes in the prices of imports in other countries. The dollar is, in addition, a key determinant of aggregate trade volumes for the world outside the net of the United States, since the dollar has a sharp impact on the relative price of traded and non-traded goods, and hence on markups on tradables and on the incentive to export in a variety of different countries. These patterns then have implications for economic policy. Specifically, they point less strongly than do other views to the advantages of exchange rate flexibility, since nominal exchange rates do not deliver changes in the relative prices of imports and exports, given that importable and exportable prices are sticky in dollar terms. These authors then go on to develop theoretical frameworks that are designed to shed light on the roots of this dollar dominance and on its implications. For example, Gopinath and Stein have a 2018 paper in which they show that firms in emerging market countries have an incentive to borrow in dollars in order to hedge economic risk, since their export prices and their financial obligations will then effectively be denominated in the same currency. And this symbiosis between export pricing and the currency denomination of foreign debts can give rise to a form of lock-in. It's one of a class of economic theoretical models giving rise to that result. I have a little paper that I prepared for this meeting that I'm happy to, that elaborates the other models, and I'm happy to share it with the audience if you send me an email. The common implication of those models, then, is that if there's going to be a shift from the current dollar-dominated, US-led international system, it will be a shift to a system in which there is another, presumably, single national source, and in which the bulk of trade invoicing and safe assets will be denominated in its currency. Because of the various feedbacks posited by the Harvard, what I'm calling the Harvard view, there exists just one dominant currency at any point in time, and major shocks to the system cause it to shift from one dominant currency to another. If the Harvard view is fundamentally empirical, I would argue that the Berkeley view is fundamentally historical. It regards the dominance of the dollar for much of the last 75 years as a historical anomaly, in fact, that's unlikely to persist. It argues that multipolar international monetary arrangements have been the rule, not the exception. This was true before the gold standard, when gold, silver, and bimetallic blocks coexisted and interacted. It was true in the late 19th century, when the British pound, the French franc, and the German mark all accounted for significant fractions of global foreign exchange reserves. It was true in the 1920s and 1930s, for much of which the dollar and sterling contributed equally to the stock of global liquidity and were equally important as invoicing and settlement currencies. International currency status, I would argue, has even been shared in the last 75 years, when the dollar rarely accounted for more than 70% of global foreign exchange reserves, trade invoicing and payments through SWIFT, and during much of which the dollar accounted for even a smaller share. Nor is the historical evidence consistent with the assumption that I associate with the Harvard view that traded goods prices are sticky in terms of a single global currency. I know of no evidence that import and export prices were sticky in sterling terms before 1914 or in dollar terms in the interwar period. So that may be because there hasn't been enough research on that question in those periods. Maybe this is something that we should collaborate on pursuing further. Why might the system gravitate toward multipolarity? One answer is that the country at the center of the system may not wish to sustain its dominance. Certainly, other countries have long complained that the United States benefits disproportionately from its exorbitant privilege. The U.S. federal government is able to issue debt securities to foreign investors at lower interest rates than otherwise. It enjoys an form of automatic insurance insofar as investors rush into those securities in turbulent times, strengthening the dollar and the U.S. balance of payments when this is needed the most. But the current U.S. administration may appreciate these benefits less than some of its predecessors. Then there's the view that the dollar's exorbitant privilege, in fact, confers more costs than benefits. So this is a view I associate, for example, with Fred Bergston, who has long argued that the strength of the dollar handicaps U.S. merchandise exporters. One can well imagine that this view resonates more with the current U.S. administration than its predecessors. In addition, there's the argument that reserve currency status exposes the issuer to liquidity trap risk. By definition, yields go down globally in a global liquidity trap, but they go down most in the country that is the issuer of the reserve asset, since investors are willing to pay a premium for its assets, especially in troubled times. The zero lower bound is not somewhere that a country, including the reserve currency country, wishes to be. Alternatively, the reserve currency country may wish to maintain its dominance but be unable to do so. Its capacity to issue safe assets that hold their value against alternative investments will be limited by the ability of its government to raise the revenues needed to service its debt in non-inflationary fashion. If other countries are growing faster than the reserve currency issuing country, if emerging markets are continuing to emerge and therefore growing faster than the United States, then the demand for reserves will outstrip the capacity of the dominant reserve currency country to provide them. The issuer may then respond by increasing the supply of debt securities, running chronic deficits, in other words, in which case confidence in the reserve currency will decline, or it may respond by attempting to balance its budget and its external accounts, in which case the world will experience a global liquidity reserve and liquidity shortage. So Maury Obstfeld has described this as a 21st century version of the well-known Triffin dilemma. Ricardo Caballero and his colleagues show that there's a more sinister version of the Triffin dilemma that also may arise if a single country like the United States is the sole provider of safe assets. If the global economy is growing more rapidly than the United States, so will the global demand for safe assets relative to the supply. This will push up the price of those safe assets and depress their yield, increasing the likelihood that the issuer and indirectly the world economy will hit the zero lower bound and succumb to what we now call the problem of secular stagnation. In a stagnant world lodged at the zero lower bound, previously safe assets will then come to be seen as unsafe, which will further aggravate the global safe asset shortage and push their prices up and their yields down even more. The implication then is that extended periods at the zero lower bound, which are likely to be associated with the dominance of a single global currency, are a problem. Ultimately, they're not sustainable, so something has to give. For example, in response to this safe asset shortage, additional sources of safe assets may develop and other potential suppliers read, for example, the euro area and China may take steps to proactively develop them. So this is a version of the multipolar world global scenario described above. That said, safety is in the eye of the beholder. For other governments to be recognized as safe asset providers, not only do they have to stand behind their obligations, but investors have to believe it. They have to be recognized by investors as prepared to do so. They have to be seen as so prepared by a substantial number of investors in order for their assets to display the liquidity expected of a global safe asset. The implication is that whether the world succeeds in transitioning to a multipolar international monetary system where assets denominated in several currencies are recognized globally as safe and liquid will depend on how investors solve this coordination problem. As in any international setting where there exists a coordination problem, there may then be a role for an organization like the IMF to provide a focal point for coordination by, for example, providing public information on the safety and liquidity of different currencies, encouraging orderly reserve diversification, changing the definition and the currencies included in the SDR basket. The IMF may similarly have a role in providing an external backstop for potential safe asset providers, assuming that is the existence of adequate resources. So I conclude that our best hope for a stable international monetary system going forward is a multipolar system backed by sound and stable policies on the part of the central banks and governments of the reserve currency issuers. This is not something that is guaranteed. This is not a perfect world, but I think it's at least a feasible one and a world that we can hope for. So with that introduction, let me pass on to the panelists. I think we will go in alphabetical order, starting with immediately to my left, Elvira Nabiolina, please.
Thank you. Good morning. In my remarks, I would like to speak about Russian experience and the logic behind it in the use of global currencies in three aspects: trade, debt, and holding reserves as macroeconomic buffers. The trade, the currency, the main currency used in our trade is, of course, US dollars. Though the main Russian trade partners are European Union and China, with 18% and 6.5% of GDP respectively, while the US-Russia trade is insignificant, it's only 1.5%. So China and EU. But main Russian exports items are commodities, which prices are nominated in US dollars. Thus, the export structure explains the dominance of US dollar in our trade. Meanwhile, Russia is the main trade partner for a number of smaller neighboring countries of Eurasian Union. And there we use widespreadly rubles. And 70% of our trade with Eurasian Union countries are rubles. And to a large extent, this is driven by a significant share of Russian trade with these countries and with ruble funding facilities. In our case, currencies that other than US dollar can be more in demand in trade, more reserve in terms of trade, if price setting on commodities changes. There is already some discussions on it. For example, the US representatives have recently declared an intention to switch its trade more to euro. If implemented, it could partly decrease the trade dominance in our trade. As far as Russia's debt concerned, the currency composition is almost the same as in trade, for the same reason. Our major international borrowers are companies that produce commodities. Such companies usually, as Professor H.N. Green said, usually consider borrowing in US dollars as a natural hedge because their export proceeds are in dollars. However, I believe that in the last 10 years, the US dollar has remained the main funding currency, not only because of demand, but also because of supply. These days, asset managers are main lenders, and they rely mostly on US dollar funding. Persisting US dollar dominance in the international financial markets may also be caused by relative underdevelopment of the European capital markets and slowness in opening Chinese financial markets. And the third aspect is reserve holding as macroeconomic buffers. Here, the currency composition of Russia's reserves is quite different from other countries. You can see it in slides that I distributed. But before the size, I would like to say some words about, before the currency composition of reserves, I would like to say some words about the size of reserves. I think it's one of the key features of modern international monetary system, that emerging markets, especially emerging markets, accumulate and continue to accumulate huge reserves, despite the fact that many of them introduced free-floating regime, but they need these vast international reserves first of all, for financial stability risks, to withstand financial stability risks. And because of these huge swings in capital flows, the central banks in emerging markets should be prepared to act as the lender of last reserves, not only in domestic currencies, but also in foreign currencies. Russia plays these roles as well, and we are prepared to use such instruments as FX swaps, FX repos, that can calm the markets during the period of stress and during the liquidity crisis periods. They address the core problem of emerging markets at that time, namely borrowing's ability to refinance their debt. In contrast, we are reluctant to use traditional FX interventions in spot markets, in open markets, as well as capital control, or so-called capital flow management. That we think that it's useless in the situations of stress and may only amplify market panic moods. So we have large reserves mostly for three reasons. First, as a commodity producer, we have a fiscal budget rule that largely shields our economy from fluctuations in oil prices. And when oil prices are high, as now, the rule prompts accumulation of reserves. Second, as I've said, we should have enough reserves at our disposal to calm down markets during massive capital outflows. But there is a question here, how markets interpret a safe level of international reserves. I will give an example of Russia. Russia entered both 2008 and 2014 financial crisis with a significant amount of reserves. 600 billions and more than 500 billion of dollars. And however, in both cases, the market quickly became concerned that we may lose too much of our reserves while intervening. And those concerns increased significantly when reserves declined to, say, $350 billion. The level still well above IMF reserve adequacy metrics. Of course, markets usually react to the speed of the diminishing of these reserves, but not only the speed. Markets expect that post-turbulence amount of reserve reserves would at minimum comply with IMF reserve adequacy standards set for normal times. That's why we decided to have more higher level of reserves, say these IMF standards of reserve adequacy plus some additional buffer that can reflect this amount of FX interventions during last large shocks. And that's why we estimate this level at about $500 billion. And the third reason why we accumulate reserves, we cannot fully rely on global safety net. I will speak about it later. Now, a few remarks about currency compositions of our reserves. Of course, in many countries, currency compositions of reserves are dominated by US dollars because capital flows are mostly denominated in US dollars. And central banks of emerging markets, they prefer store these reserves in dollars. The liquidity of dollar markets also matters. Nevertheless, countries as Russia with large reserves can afford significant diversifications to manage better their risks. And these risks are, in our case, are not purely economic. They are also geopolitical. That's why we diversify reserves probably to a greater extent than others you can see in the slides. One may ask, is it reasonable to accumulate excessive reserves and to build up significant buffers? In our circumstances, the answer is definitely yes. We prefer to have our own reserves rather than rely on an international safety net. We cannot rely on swap lines, liquidity swap lines with major central banks. The IMF new liquidity provisions facilities are promising, but they suffer from the stigma effect and cannot be disbursed quickly. Russia participates in a regional safety net with other BRICS countries, but the net capacity is quite modest yet. For example, our reserves are almost 25 times higher than the maximum amount that we could get from the BRICS CRA facilities. I think a similar logic could be applicable for other emerging market countries which face a difficult to manage foreign currency liquidity challenges. Thus, these days, emerging market central banks' reserves amount to about $7 trillion, while the total amount that IMF can lend to its member countries is about $1 trillion, or about 15% of emerging market central banks' reserves. But the large uncoordinated increase in demand for US dollar reserves aggravate the threat of the trilemma, of Triffin trilemma in its modern form. And filling gaps in the global safety net seems to be essential. We need a more functional, more pragmatic and less politicized financial safety net for emerging market central banks so that they can act as a lender of last reserves in international currency. And this can diminish the need for central banks of emerging markets to build large international reserves, and this can reduce global imbalances and improve the work of international monetary system. And Professor H.N. Green has convincingly argued how multipolar system can evolve from current system. And I think it can diminish the Triffin dilemma for the countries issuing reserve currencies. But for emerging market currencies, the challenges remain because we face these problems with capital outflows. And that's why the development of global safety net, I think it's the key decision in that aspect. Thank you. I will stop here.
Thank you, Madam Governor. So I hope we can have more discussion of the question of whether more reserves really make countries and their financial systems safer, and about the costs as well as the benefits of holding international reserves when we get to the Q&A. The second panelist is Tobias Strassmann. Thank you to the organizers for giving me the company of another economic historian.
Right. Okay, thank you very much for the invitation to this high-level conference in this rather low-temperature city, but I have a warming message for you. As an economic historian, of course, I tend to endorse the Berkeley view, because most of the times the international monetary regime has been multipolar, hybrid, and somewhat disorderly. Even during the classical gold standard in the late 19th and early 20th centuries, a system considered to be nearly perfect, the leading countries pursued different policies and tried to bend the rules for their own benefit. There were even impediments to international capital mobility, so the trilemma did not really play out as we sometimes think when we teach monetary history. International financial crisis threatened to overwhelm the cooperation of central banks and governments. Sterling was the dominant global currency, that's true, but for example, during the Baring crisis of 1890, the Bank of England needed desperately help from the Banque de France and others. So the classical gold standard was far from a perfect unipolar world, and I think the same is obviously true for the interwar gold exchange standard and the latter part of the Bretton Woods system. And finally, it's true for the international monetary system since 1973. And I think the current rebalancing of world economic and military power, which is always the main driver of the change in the international monetary system, will eventually lead to a multipolar system. We're already quite on our way. There is no doubt about that, I think. Since I agree on this point, I would like to expand the focus by following up on what Barry Eichengreen in his paper considers, quote, the best hope in my view, namely a multipolar system backed by sound and stable policies on the part of the central banks and governments of the reserve issuers. I'm concerned about the following questions. What happens if the authorities of the reserve currency issuers fail to maintain entirely sound and stable policies? How much tolerance is there? First of all, I think there are good reasons to assume that such a scenario is the most likely one, especially if we extrapolate the recent past. Just a few remarks. I don't think they're controversial, but anyway, I think in the United States, political gridlock is likely to continue, making it nearly impossible to put fiscal policy back on a more sustainable path. Well, maybe it is controversial. I don't. Banking regulation has been patchy, and I think the US will continue to experience a relative economic and military decline, and thus be even more tempted to use the dollar weapon to maintain its hegemony. And this in turn will increase the demand for alternatives to the US dollar, but I do not see that policies in China and the European Union or in the Eurozone are about to become more sound and stable in the foreseeable future. Of course, China will continue to liberalize its capital account and privatize parts of the financial system. There will be evolution towards, typical world power in the monetary system, but my impression is, and this is maybe really controversial, but that's probably why I'm invited, is that keeping such a large and complex country as China stable prohibits a full-fledged political and economic liberalization required to meet the conditions of a world currency like the US. And the European Monetary Union has shown some improvement, but it remains incomplete. So presumably the international monetary system will become more multipolar, but probably more disorderly and maybe more volatile. So these worrying trends raise another question. Are we about to experience a period comparable to the 1920s, when an unstable international system paved the way for the Great Depression of the 1930s? There are obvious parallels. As the economic historian Charles Kindleberger observed, the 1920s were a period of transition characterized by a power vacuum. No longer London, not yet Washington. Today we can observe a similar shift, less Washington, more Beijing. Some countries tailored their policies according to the principle beggar thy neighbor. Germany, for instance, opted for hyperinflation in 1923 in order to reduce reparations, regardless of the negative consequences. France in 1928, for example, deliberately fixed its exchange rate at an undervalued level in order to boost exports and attract gold. Today, the European Monetary Union seeks to grow out of its problems by running a large current account surplus against its main trading partners. China has repeatedly resorted to devaluation. The Trump administration has introduced a series of protectionist measures, so we have some parallels. On the other hand, and this is why I'm guardedly optimistic, we can identify two enormous differences. First, the 1920s were in the shadow of a catastrophic world war. I think today's world has been more peaceful for decades. There is no power, for example, about to take vengeance for a lost war in the recent past. There are no international political debts like reparations contaminating diplomatic negotiations. And second, the interwar gold exchange standard was an outdated, rigid regime, while today's patchwork system of floating and managed currencies has proven to be flexible and resilient for quite some time. Yes, we've had several financial crises, but the global economy was able to cope with all of them. Thus, and that's my concluding sentence, there is reason to believe that the shift to a multipolar and hybrid and somewhat disorderly system can succeed, even if the policies of the currency issuers are not entirely sound and stable. I think there is quite a bit of tolerance. The international monetary system has been and will be far from perfect, but by historical standards, I think it's in a pretty good shape. And your remarks, you were guardedly pessimistic in some respects, but on the other hand, you showed how even an emerging market can cope with different leading currencies. Thank you.
Thank you very much. The New York Fed has historically played a disproportionately important role in management of the international monetary and financial system, so it's appropriate that our third panelist is John Williams.
Thank you. So John Maynard Keynes is credited with saying, when the facts change, I change my mind. What do you do? Over the past decade, policymakers across the globe have been focused on getting their economies and their financial systems back in order. But at the same time, a sea change in supply-side realities has taken place. These changes have redefined what is achievable and challenged conventional wisdom on monetary policy. Shifting demographic trends and a slowdown in productivity are driving slower trend growth and historically low levels of real interest rates across the globe. These new set of facts require all of us to rethink what we once knew, reassess how to best foster strong and stable economies, and ready ourselves for the future. Well, given that I've said all that, I probably should give the normal disclaimer that everything I say reflects my own views and not necessarily those of the Federal Open Market Committee or the Federal Reserve. Okay. Following the global financial crisis, central banks took bold and decisive actions to right their economies and bring them back to health. Short-term interest rates were brought to near zero, in some cases below zero, and held there for many years, as this chart shows, for 5 areas. The combination of low short-term rates and asset purchase programs and other unconventional policies drove down long-term yields and sovereign debt to historically low levels. In large parts of Europe and Japan, short and long-term yields remained near zero a full decade after the onset of the financial crisis. Now, economic developments since this unprecedented monetary stimulus provide insights into the efficacy and the limitations of monetary policy. On the positive side of the ledger, advanced economies have seen steady growth and significant declines in unemployment, with unemployment rates today near, or actually in many cases, well below those seen before the crisis. Bold monetary policy actions surely played an important role in averting far greater catastrophes and have aided economic recovery. However, this success was achieved only after a disappointingly slow recovery and many years of economic hardship. And despite the improvement in the real side of economies, inflation rates have persistently been below central banks' goals. The fact that inflation has been running below target in most advanced economies, and the United Kingdom being the prominent outlier, suggests that this challenge of low inflation is not due to factors specific to a single country. Instead, there are more systemic factors at play. Now, importantly, investors are increasingly viewing these low inflation readings not as being an aberration, but as actually a new normal. So this table shows market-implied inflation, long-run inflation expectations in 4 regions and how they've changed in the past decade or so. This is evidenced by a broad-based decline in market-based measures of long-run inflation expectations in the U.S., the Euro area, even Japan. Again, the UK provides the exception to the rule. So this experience of slow recovery and persistently low inflation is a symptom of a much deeper problem afflicting advanced economies across the globe, the root cause of which is a combination of low neutral real interest rates and the lower bound in interest rates, a topic to which I'll now turn. So underlying these events has been a sea change in the supply side of economies, owing to fundamental shifts in demographics and productivity. 2 demographic trends are evident. People are generally living longer, which is a good thing, and population growth is slowing. So if you look at overall life expectancy in member countries of the OECD, that's increased from about 65 years back in the 50s to nearly 80 years today, and it's projected to exceed 90 years by the end of the century. And despite the increase in longevity, dwindling birth rates are bringing population growth to a standstill. In OECD countries, population growth averaged around 1% back in the 50s and 60s. Now it's running about 0.5% per year and is expected to gradually fall and actually turn negative later in the century. Now, when it comes to productivity growth, the changes here are no less dramatic. In OECD economies, growth in labor productivity, output per hour, has averaged a little over 1% a year since 1995, since 2005, about half the pace seen over the prior decade. A major factor driving the slowdown, this productivity slowdown, is a dramatic decline in the growth rate of total factor productivity, or TFP, the measure of innovation and technological change, which is near 0 in the past 10 or so years. So as Bob Gordon has taught us, at least in the U.S., productivity growth tends to cycle between periods of high growth and decades following a fundamental breakthrough in science and technology, and then relatively fallow periods of steady incremental improvements. All the evidence indicates that we're in one of those latter normal periods of productivity growth of between 1 to 1.5% per year, and that things will likely stay that way until the next scientific or technological revolution. So bringing this all together, these global shifts in demographics and productivity have 2 important implications for the future of our economies and for monetary policy. First, slower population and productivity growth translate kind of directly into slower trend economic growth. And second, these trends have contributed to the dramatic declines in the longer-term normal or neutral real interest rates, or R-star. Slower trend growth reduces the demand for investment, while longer life expectancy tends to increase household saving. And this combination of lower demand and higher supply of savings, along with other factors, has pushed down R-star. And with open capital markets, these global changes in supply and demand affect R-star globally. The evidence of a sizable decline in R-star across economies is compelling now. The weighted average of estimates for 5 major economies, which shown in this chart, that includes Canada, the Euro area, Japan, the United Kingdom, and the United States, has declined to 0.5%. So it's a real short-term real interest rate of 0.5%. That's about 2 percentage points lower than the estimates that prevailed in the decades before the financial crisis. Now, a striking fact that from these estimates and others, and you can see in this chart, is that there are no signs yet of this R-star moving back to more normal levels, even though economies, as I pointed out earlier, have generally recovered from the crisis. And given that these demographic waves and sustained productivity growth slow down around the world, I see no reason to expect R-star to revert to higher levels in the foreseeable future. So the global decline in R-star will continue to pose significant challenges for monetary policy. Given the limited policy space for interest rate cuts in future downturns, recoveries will be slow and inflation will run below target. This limitation, the ability of central banks to offset downturns, results in an adverse feedback loop whereby expectations of low future inflation then drag down current inflation and further reduce available policy space. So policymakers around the globe need to prepare for the challenges of navigating the new realities of slow global growth and low R-star. This necessitates new thinking and approaches to monetary, fiscal, and other economic policies. Starting with monetary policy, central banks should revisit and reassess their policy framework, strategies, and toolkits to maximize efficacy in the low R-star world. The Bank of Canada regularly does this, and the Federal Reserve is currently undergoing a review of our framework and strategy. Absent such changes, central banks will be severely challenged to achieve stable economies and well-anchored inflation expectations. Outside of central banks, there are a number of avenues by which fiscal authorities can enhance the resilience of economies to negative shocks. One is to strengthen the so-called automatic stabilizers that provide a boost to the economy during a downturn. A second is to align debt management decisions more with the decisions in monetary policy. For example, during a downturn, the fiscal authority could choose to shorten the duration of debt issuance to reinforce or support the effects of central bank quantitative easing. Third, regulatory and supervisory policies that support the resilience of the financial system can limit the economic effects of negative shocks. Finally, and perhaps most importantly, fiscal and other economic policies can attack directly the sources of slow growth and low R-star. This includes raising public and private investment in human and physical capital, in infrastructure, science and technology, and policies aimed at removing barriers to participation in the labor force and the economy more broadly. The facts have changed, and so it is time to change our minds. It's often said that change is hard, but experience teaches us it's better to prepare for the future than to wait. Ultimately, failure to prepare often means preparation for failure. Thank you.
Thank you, John. So I would note for our discussion that we now have two sets of quite different explanations on the table for the low level of R-star. On the one hand, factors like demographics and productivity. On the other hand, the global supply and demand for safe reserve assets. How important are they relative to one another? Finally, we have Amir Yaron from the Bank of Israel.
Thank you, and good morning to everyone. I'm not a macro historian, but we'll try to give a few perspectives from a small open economy. If you look at, if you actually look at these figures, who are taken from a three-authored paper, you could actually see that the world is still very much remain with a limited flexible exchange rate, even though there's been a far movement from a fixed exchange rate. And yet, the dollar share as an anchor currency is, and this is not news to everybody, but is still the dominant and has actually grown over time. So I think going back to the questions that Barry has put forward in terms of polar versus multiple, it would be useful to pin down the sort of more micro foundation of what is causing all of this. And here I borrowed, Gita is here, so I think her focus on invoicing and the idea that in the figure here you see that Japan and Turkey look more alike in terms of pass-through to exchange rate than the U.S., even though in many other senses Japan and the U.S. are closer, and the focus here is indeed on the invoicing. And of course, that leads to something that was already mentioned about the asymmetric monetary policy effect of those that are the reserve currency versus those that are receiving this currency depreciation. And the next layer, of course, is the feedback that goes from here and back and forth from having a dominant financial currency and through reserve management. So I think going back to Thomas's earlier comments about where are we going forward, understanding something about the micro foundation, and here this invoicing gets very close to the issue of payments, something that I'll get back to if I have time down the road. So back to Israel as a small open economy, no pun intended here, we are literally price takers in this kind of global system. And of course, the anchored currencies is highly influenced by our inflation target, monetary policy, the economic activity, trade and capital flows, both locally and globally. We are very open and significantly affected by exchange rate. There are some estimates here that you could see. The exports are about 30% of GDP. Over time, moved from manufacturing more towards services, particularly the high-tech sector. And so we are highly sensitive to the exchange rate and therefore also to sort of the anchor currency. So if you look at the history of Israel, for example, and since this is sort of a past, this is only my 2 slides of looking at sort of past, we are sort of moved along with the way the global environment has evolved. The exchange rate has moved from a fixed exchange rate regime to a managed float, and later on to a free float, and later on to a float with intervention, okay, which is kind of, and now we are closer to a float that tries not to intervene. So Jacob Frenkel is here. So in the early 90s, after the stabilization program of 1985, which succeeded in bringing Israel from a hyperinflationary environment to a low double-digit inflation rate, the exchange rate served as effectively as the monetary anchor. And however, the disparity, given that we are highly influenced definitely by the US, but also by Europe, I'll show you in a second the trade structure, the disparity between local and global inflation and between the US and Europe has often required recurring alignments of the exchange rate, and therefore involved large capital flows. There's a figure here that you could see how the exchange rate was around a band, and then it moved towards sort of a band that was upward trajectory, etc. So if we move towards 2008, on the background of the global financial crises, the Bank of Israel adopted a policy of intervention in the Forex market, first in a pre-announced daily amounts, and later on by a discretion. And so this intervention is an additional monetary instrument that effectively for us as a small open economy is like a QE type of instrument. And together with the forward guidance, it sort of assists us in the monetary policy in achieving targets. And this is in spite of having a low, not a negative interest rate, but a low interest rate of at that point of 0.1. It's currently at 0.25. So here is the, at some point, even though I showed you the dollar is the dominating, is growing as the dominating currency, the Bank of Israel has moved to target itself against what it's called an effective exchange rate. And you could see here the various figure of trades, and then this effective exchange rate is trying to create some normalization vis-a-vis our trading partner. And you could see, by and large, if you look at the 2 figures, you have the shekel versus the dollar and versus the effective exchange rate. They're highly correlated, but they're not perfectly correlated. And of course, if you have an intervention policy, which one you benchmark it against can even affect those considerations. More recently, we have found natural gas and warring off some of the Dutch disease potential. The Bank of Israel has, at that point, as I said, intervention in fixed amounts, and then it went into a more discretionary part. And as you can see at the very latter part of this slide, we are hardly intervening. The yellow bars are the purchases to offset natural gas effects. So we have accumulated, just like Evelina said, we have accumulated quite a bit of reserves. It's right, at this point, it's about 32% of GDP. Their composition is in front of you, and I wanted to say that the same issues that you mentioned are also relevant for us. There's the issue of liquidity, which comes from economic reasons. It comes from geopolitical reasons. There's the safety of the assets we want to engage in. But as you are getting into a level of reserve that is at 30% of GDP, you start asking yourself, and there are people asking, what is the return on these reserves? And just like we hear in other areas reaching for yields, you know, you have to ask yourself at what point you keep on using the same you know, the same bonds and typical investment that we've seen in the past, and the Bank of Israel has moved on a small component, you know, experimenting with investment in other areas that it had in the past, knowing that it does have this cushion. You know, so as I said, the local monetary policies is conducted given global monetary policy, which was ultra accommodative after the global financial crisis. And, you know, both the capital movements and the exchange rates are affected, among other things, by yield differentials. As I said, we are highly influenced both by the US, but also by Europe. And there's now a big disparity between the two. And that always puts us in a place of thinking of, if we change things, in what way will that lead to possible capital flow, affects the foreign exchange, and maybe mitigate whatever we want to do in terms of want to do in terms of monetary policy. I would also say that the spillover, I talked about the financial sector, it seems that financial markets themselves are also more integrated and correlated, and therefore, again, it seems that this global monetary policy, both in yields and in stock markets, is affecting our, to some extent, our ability to have a complete sort of independent monetary policy. And the last thing I mentioned, the FX, is the macroprudential steps, which is sort of the last bit that we've done in terms of trying to maintain a monetary policy that is not completely dependent on the interest rate themselves. Let me just get back to are we seeing some changes? We're seeing more in emerging markets. We're seeing more sovereigns actually shifting their debt towards local currency. It obviously naturally matches their currency of assets and liabilities. It also seems to be correlated with a typical finance argument of reducing credit spreads through diversification, and therefore reduction in exposure to global risk factors. So that's a change that's countervailing this move towards dollar that I've shown you earlier. And here I go back to this invoicing issue. We do have modern financial instruments. You could ask, why are these firms at the very micro foundation aren't using more of these financial instruments to hedge and get away from the argument that it has to be done with dollars. And finally, the last slide is, which I think is what Jordan was talking about, will the exchange rate regime, and in particular the anchor currencies, be affected by these technological advancements in the financial sector? I think the spread of e-commerce and generally the digital economy is a big open question. And here, the issue of invoicing and having even big companies being able to do local and global invoicing in a very efficient and fast way may change the way we think about these things. And I look forward to other comments in this regard. Thank you.
Thank you, Amir. More than 30 years ago, Robert Solow made that famous quip, we see the computer everywhere but in the productivity statistics. So I think one sentence summary of this panel would be, we see reserve diversification everywhere but in the COFR statistics. Another summary of this panel, I suppose, would be a dominant trend of the last 75 years of international monetary history would be rising international capital mobility, from which has followed a more flexible exchange rate, from which has not followed the decline in the demand for international reserves that was anticipated by people writing at the time of this shift. So again, Jacob Frenkel is here, and he did some of the pioneering work documenting, anticipating that reserve demand would go up with the shift to greater flexibility rather than going down. So the question, another set of questions for discussion would be, will these trends continue? Are these trends in the direction of greater exchange rate flexibility and more demand for international reserves sustainable or not? So with that, I will throw the floor open for questions and interventions. Gita?
Thank you. That was a very interesting panel, and I'm glad to be associated with a view. I agree with much of what you said, including the fact that the distance between the Harvard and the Berkeley view is not that great. But I want to emphasize one point, which is that in the emergence of a dominant currency, there are certainly forces that work as complementarities, that basically give you a reason why you can have a lot of persistence in the life of a dominant currency. And that's because it tends to be dominant currencies tend to be dominant in invoicing, they tend to be dominant in the financial side, and the two feed back into each other. So what that means is that if you want to think of a move towards a multipolar world, we have to think of what the alternatives would be. And that would require a country that's not just big in international trade, like China is, but that also has a very strong and well-developed financial system, which it is not there yet at this point. If you think of the euro also has is a big player in international trade. And if you look at the Eastern European countries that trade with the euro area, they do use the euro more as a dominant currency than they use the dollar. But then the question is that we don't have a euro safe asset. So in the absence of a euro safe asset, the question is, will we get that wonderfully feedback loop that would then generate a second strong dominant currency? So I guess I'm of the view that at least for the near term, I mean, unless there is a serious coordination towards another currency where everybody decides to invoice in another currency, and to use payment systems of another currency, it's the forces for such a move at this point seem fairly weak.
I see Tobias and then Jacob next.
Yeah, I have two questions. So the first one to Elvira and Amir. Last year on this panel was the governor of Australia who said, well, I don't have any reserves. And my currency just floats around. So why is it that some countries don't ever intervene, even though they're also commodity producers, they also have dollar invoicing, whereas, and this holds for Australia, but it also to some extent holds for some emerging market countries such as South Africa that is represented here, or Chile. So what is sort of like the structural difference that you see that makes you intervene at some point, even if you don't do it in normal day-to-day operations, at some point in times of crisis or liquidity you do? And, is there some obvious difference structurally? So that's my first question. My second question is to John. So John, I just want to bounce back Barry's and Tobias's question. Your pitch was all about the supply side. There's demographics, there are productivity differences, and this is driving down R star. But of course, there are all these other theories about safe assets, dominant currencies, that's about convenience yields. And so there might be a totally different reason why R star is low. So what's your view of that?
If I may, let me turn back very quickly to Amir and then to John. If you want to respond to Tobias.
Just, I can't speak for as a small open economy, obviously, who went through structural, again, this is, I'm describing the past, not the present, but I think there was a fear that that if the exchange rate appreciates too much, old industries would potentially get wiped out, and you know, some of the intervention was done to allow them to gradually go through the transition and, you know, sort of efficient destruction as opposed to immediate one. That was one aspect. The other aspect, as I showed you, was the fear of Dutch disease. You know, so in general, I think we would like not to let it be determined by market forces unless there's some real disruption, in which case we will be able to intervene in the market.
Yeah, on the question about other factors driving down the neutral interest rate, in my prepared comments I said among other factors, so to cover that. So I think, you know, if you look at these different model estimates, and now there's a lot of work using different types of models and frameworks to look at this, you get anywhere from 40 to 70% of the decline is from fundamental factors, the rest unexplained factor, perhaps convenience yield, perhaps is, you know, demand for safe assets. So I do think that's part of the story. The reason I emphasize these real side factors is I think that they're a really important part of the story too in the global economy. So sometimes I find that the safe asset story, especially in these kind of forums, gets a lot of the emphasis, and I think it's really important to cover these others. The other point is that the global aspect of this, it's not just the U.S., it's not just the Japan, it's not just the, you know, EU countries. It's really striking that these demographics and productivity trends are seen across the advanced economies and, quite honestly, in the emerging market economies as well. One comment I often hear is, well, if you're in the emerging market world, this effective lower bound, that's not going to hit us. But of course, if you look at interest rates in emerging market countries, they've come down pretty significantly in the last few decades. They're still well above zero, but these trends, I think, are hitting them as well.
I think it's a great fundamental question. Why the reserves are needed in the situation when currency is floating freely. In our case, free floating currency rate works as a shock absorber in the situation of terms of trade shocks, but not in the situation of capital outflows shocks. And I think if we are successful in implementing macroprudential measures in advance and not to have some imbalances, some over-indebtedness, over foreign currency exposure, we cannot intervene as many countries, as some countries, I think. We need to use more these preventive, preemptive macroprudential measures. It's about interventions. We don't intervene to distort market forces, to just to impede adjustments of the economy, but only we think we can intervene to calm down market panics, to calm these moods when capital outflows can be massive and markets can be surprised. Only in this situation. Thank you.
Now is a good time for me to remind you we have 10 minutes left, and I have 4 people on my list at the moment, 5 people on my list. Jacob?
Thank you. The subject is the international monetary system, past, present, and future. And as we look at it, we are now very much under the impact of 2 different paced events. One, 70 years, 75 years since Bretton Woods, and second, 10 years since the great financial crisis. And they are fixing our minds in different ways. The first element, namely the Bretton Woods era, the main change that has taken place since is the development of capital markets and capital flows, with the implied differences. The second, the great financial crisis, the fact that remained with us is the short-term focus that is the legacy of the great financial crisis. As we will look, say, in 20 years, I think that the weight of the GFC in determining our mind will be very different than the weight of the preceding 75 years. So I think that in this regard, we need to ask ourselves, what kind of changes are temporary and what are not? And I liked the organizational principles that Thomas laid at the beginning, saying there was a search for an anchor, a search for instruments, etc. The three instruments that were mentioned, namely Forex intervention, negative interest rates, and maintain exchange rate floor, by definition, are not sustainable. They may be useful at the time, but they are not sustainable, which means that if they characterize the present as we take the journey from the past to the future, their role in finding a place in the future will diminish, and therefore we will need to come back to the question, what will be the instruments in the system that will evolve in the post-Bretton Woods era with capital flows? Will it be with, without capital interventions or not? And this brings me to the focus of Elvira's point, which I thought was very well placed. I wrote down the word, we are reluctant to use the capital flows. Not because they don't want the results of the intervention, but because the results that they aim at will not actually come to bear. And therefore, the issue is it a general rule that capital intervention should not be used, will not be used, where will it be, etc.? And I think that we should really draw a distinction here between emerging economies and advanced economies. Emerging economies really cannot afford losing both the discipline and the fruits that emanate from capital flows. The more advanced economies can play this game. And the dual to it is the need for reserves. Barry, you asked, do we need international reserves? After all, flexible exchange rates, capital markets should have taken care of it, and we see that it's not. Because international reserves are self-insurance. Who needs the self-insurance? Those who will not have access to the capital markets in bad times. And frankly, the more you intervene in the capital market, the more likely is that you will not have the access in the bad times, and the more likely that you will need to resort to self-insurance. So I think that we should think separately between developed and the developing countries. And my final footnote is about the remark that John Williams made, which was actually very perceptive, reminding us about Keynes, when circumstances change, I change my mind, what about you? But remember what John Robinson answered to him, his student. He said it when in a little room together with Roy Harrod and John Robinson, and she said, that is correct, but we need first to check the facts and we need to understand them before we change our mind.
So time is growing shorter and the list is growing longer. Jacob, if you could pass the microphone 2 seats to your left.
Yeah, I'm Harris Dellas from the University of Bern. I have a simple but I think fundamental question that regards the number of reserve issuing countries, world nominal interest rates, and the zero lower bound. So it relates to something that Barry said. So when we teach basic macro, we determine nominal interest rates by equating the demand for money to the supply of money. Under international capital mobility, this implies that the world nominal interest rates would be determined by equating global demand for money to global supply of money. So my question to Barry and also to John is, are there any reasons to believe that the composition of the world supply will matter for the determination of the interest rates? Because this is something that Barry mentioned, that if you have like one country, then it is easier to, or more probable to hit the zero lower bound than if you have more than one reserve. So this is, the world of monetarism, Switzerland, we have a long tradition. So I think this is a natural question to ask. Thank you.
So my 10-second answer would be that there's an argument that not all currencies are created equal from the point of view of providing safety and liquidity internationally. So from that point of view, composition does matter. Yes.
Well, thank you. This is Ahmed Al-Khulaifi, the governor of Saudi Arabian Monetary Authority. From the perspective of a single commodity producer, I think keeping the reserves is obvious, is very important for us. You want to insulate your economy from the volatility of oil market. This is very important for us. And if you combine this with the exchange rate arrangement that we are following, that's the peg to the dollar, then you want to enhance confidence in that arrangement as well. In addition to that, you want to use the reserves in times of lower oil prices, as it happened in the history. So the short answer is yes, it makes us safer. Whether more demand of international reserves in the future, well, with the uncertainty we see, I'm afraid most likely the answer would be yes.
I think we have time for Governor Nowotny and Governor Sternaris.
Ewald Nowotny, Governor of the Austrian Central Bank. It was already mentioned that there doesn't exist a safe European asset, so nothing like this big liquid markets that we have in US treasuries. We have studies on that and working groups. There was one working group chaired by Philip Lane, who is our incoming chief economist at the ESRB. I was also a member of this, but we have no perspective of this. Now we have also the project of a European Capital Market Union. And so my question is, do you see a working European Capital Market Union feasible without a safe European asset?
Do you want to try?
Okay. Can I think about it and give an answer later? At the end, I'll make a final remark.
So my view would be actually that Europe can go a long way in the direction of capital markets union without the equivalent of Eurobonds, which I think is what you're referring to. Reasonable people may disagree, but that would be my initial position, I think.
Thank you. That was a very good panel, and thank you for the insights. From what has been said, it seems that despite the pros and cons, the current international monetary system proved to be quite resilient, and the problems we have, or we had in 2008 in the United States, then in Europe, they were mostly regional problems having to do with bad policies, inadequate supervision, and the current monetary system, which is quasi-dollar-based, but moving into a multipolar one, and the speed of the movement will depend on whether China, for instance, will open its capital markets, while Europe will obtain a safe currency, as Ewald said. So can we say that it is mostly a regional question, the problems we have today, rather than a problem of the international monetary system per se? And second, the other reason of our troubles today is the low growth rate, low productivity rate. Perhaps to invoke Solow again, we might be in this time lag that Solow has talked about the paradox of productivity. Here we have new inventions today, but it will take time for these inventions to be translated into higher productivity and higher growth. So here, can we say that monetary policy should not be the only play in town, but fiscal policy, structural policy should encourage investment in research and development, so at the end of the day, R* will go up and productivity growth will go up? Thank you.
Anyone? I'm happy to give it a go. The argument that it's not simply a set of regional problems is that the structure of the international monetary system amplified and served as a transmission belt for national and regional problems, that the US was able to go further out on the subprime limb, if you will, as a result of the global demand for dollar-denominated assets that were perceived as safe until they were revealed to be unsafe. The system served as a transmission belt of those problems from US banks and financial institutions to European banks and financial institutions because of the importance of dollar-denominated credit. So that's the argument that the international system mattered that we can develop as the day unfolds. Finally, last 30 seconds, I will invoke my moderator's exorbitant privilege to engage with Gita just for a moment. I think we agree that the answer about what kind of system will develop going forward depends on the importance of these complementarities between the different functions of international currencies. We both have intuitions about that are shade in slightly different directions, but we don't have the kind of systematic empirical evidence yet, I think, to be confident about how strong or weak those complementarities are. So with that, let me thank everybody involved. I think the next stage is a coffee break.
The lead speaker for the panel on the IMS in a changing global landscape will be Professor Charles Engel from the University of Wisconsin. Please.
Well, thank you very much, and thanks very much to the International Monetary Fund and the Swiss National Bank for organizing this conference. It's been really productive and informative. So this session's on the future of the international financial system, and we're going to follow the same ground rules as before, that I'll have 15 minutes of introductory comments, and then I've been told to strictly enforce the 10-minute limit on our distinguished panel, but then I haven't been given any enforcement tools, so we'll see how that works. Being an American, I might threaten to impose financial sanctions, but being American, there's nothing, no sanctions can be imposed on me, so we'll see how that goes. Now, so it would be presumptuous of us to try to forecast the next 75 years of the international financial system. What we can do is discuss the factors that are currently effecting change in the international financial system. And one of the major factors, of course, is financial technology. So FinTech offers the promise of making the international financial system more efficient. It could speed international transactions in finance and facilitate international trade and potentially increase financial inclusiveness. But then it poses challenges for the implementation of monetary policy and certainly for financial regulation, for policies dealing with financial crises, and it brings serious concerns about cybersecurity. Now, a particular set of concerns has arisen over privately issued digital currencies. And again, the questions are whether those digital currencies could actually supplant central bank currencies, but maybe more importantly, how do they affect monetary policy transmission? How do they affect the payment system? How do they affect financial stability? Now, in my limited time, I am going to just focus on one aspect of these changes, which has gotten a lot of attention at several central banks, which is the possibility of introducing central bank digital currencies. And my remarks here are really just a short summary or a survey of the literature that's been written, a lot of it by the central bank economists, but also academic economists. And I'm going to focus in my remarks on the so-called retail CBDCs, that is the digital currency deposits that would be available to households and firms. And I'm not going to really discuss the possible benefits of these accounts in speeding settlement of transactions. And instead, I'm going to focus on the investment characteristics of CBDCs. So in particular, the central bank digital currencies offer an opportunity for investors to hold another form of a safe and liquid asset. And so what do I mean by a safe asset? Well, that's an asset that has low default risk, that has relatively stable value, and an asset for which there's very little private information so that the buyer of the asset can be confident that he is not getting cheated. A liquid asset is an asset that can be used sometimes to make transactions, or at least it can be used as collateral, and it's an asset that has a deep market so that it can be sold easily even during times of turbulence. And so I think we can say that safe assets are liquid, and that all liquid assets have the characteristic of being safe. Now, it's generally viewed that for a well-behaved government that those assets are safe and liquid. And I want to categorize the liabilities of the government, and here I mean the consolidated balance sheet of the government, including the central bank balance sheet, and begin then by listing some of the properties of these different liabilities and how central bank digital currency would differ from these other government liabilities, but all of which I presume have some aspect of safety and liquidity relative to privately issued assets. So currency is is a very liquid asset, but it's also a cumbersome asset for making transactions, and it's very cumbersome as a store of value. I mean, that's why we've been able to drive interest rates below zero in some cases. Currencies don't pay interest, and on the other hand, they can be used easily in transactions, and importantly, they maintain anonymity. Now, reserves, and I'm talking about here reserves held at the central bank by private banks, are, of course, very liquid, and they pay interest, but their drawback is that they're only available to banks. Bonds, government bonds, are considered to be liquid and safe, but not as liquid as currency or deposit accounts. They do pay interest. So where does a central bank digital currency come in? Well, they could take two forms, and I'm not going to spend much time here on the token-based CBDCs. You could think of these as sort of a digital Bitcoin or a central bank Bitcoin. And so one possible advantage of a token-based CBDC is that it can maintain anonymity. It could be designed that way. It doesn't have to be designed that way. And indeed, I mean, it seems unlikely to me that there are many central banks that would want to issue yet another asset that allows anonymous transactions. I mean, many central bankers feel there's already too much of that going on. The other drawbacks of the token is that it's difficult to arrange how to pay interest on a token. And then some of the studies have discussed the possible difficulties of maintaining parity of a token with the physical currency. So I'm going to set those aside and mostly now focus on CBDCs that are a claim to an account at the central bank. And we can think of those, they're sometimes called reserves for all. And the idea is that the public, the households and businesses would have access to accounts much like reserves. They would be, of course, liquid. They possibly could pay interest. They're a less cumbersome asset than cash, and they can be used in transactions, but they would not be anonymous. So one of the main rationales, I would say, for creating such an account is to give the private sector access to an asset that has the same safety and liquidity characteristics as reserves, which otherwise is not currently available to the general public. So what are the competitors? What is available to the public? Well, the privately issued assets, for example, deposits held at banks, are an obvious alternative. And as many of the studies have pointed out, and don't take offense when I say this, but the private sector may be better at creating new products and may be more efficient and less bureaucratic than central banks. and so they may have an advantage over central banks in that regard. But they have the problem that they are not generally considered, deposits at a private bank are not generally considered as safe as deposits that would be held at a central bank. Now, there are insured deposits, and so they have the backing of the central bank, but there are limits on deposit insurance, and besides which deposit insurance has its own drawbacks as a means of providing safety, because then they create moral hazard on the part of the private banks because the depositors have less incentive to monitor the behavior of the private bank. Now, another possibility that's been floated is starting narrow banks. So narrow banks are banks that would take in deposits and invest them entirely in reserves, and that way depositors would, would have an additional degree of safety. I mean, they're still not as safe, I would say, as an actual central bank deposit, because you still don't know exactly what the owner of the narrow bank is up to. But they have a lot of the same characteristics. But there is one drawback that I'm going to mention in a few minutes. And then there's the hybrid accounts, which are basically accounts that would be established at current banks, but would be somehow segregated, and these accounts would be backed 100% by deposits, reserve deposits held at the central bank. So those would have a lot of the same characteristics as a narrow banking proposal. So first of all, what's motivated this interest in central bank digital currencies? Well, I think a lot of it was motivated from the fear that the central bank currencies were going to be replaced by digital currencies. Now, my own opinion is that fear is unfounded, or at least it's premature, because digital currencies, first of all, have not been very useful for making transactions. As we know, the value of the digital currencies has fluctuated pretty wildly. And in any case, digital currencies still really don't replace a central bank currency, because they don't function as a unit of account. Goods and services are priced in central bank currencies. We have dollar prices or euro prices of goods. We don't have, if you go to the store, there are no goods that are priced in Bitcoin. So if you're a Bitcoin holder, you're still, in a sense, taking on foreign exchange risk if you want to then use your currency to buy goods and services. So what are the benefits then of a central bank digital currency? Well, as I said, it gives the non-bank sector access to a safe and liquid asset with the same characteristics of reserves. It's been argued that in some countries it's going to improve access to the financial sector. For governments, it may be a less expensive way to finance debt because you can pay a lower interest rate on CBDCs than on short-term debt because of their liquidity properties. And in essence, it may be that a country that issues a CBDC can capture some of the exorbitant privilege that the U.S. enjoys. The U.S. has enjoyed the ability to issue debt at a very low interest rate because U.S. Treasury bills are considered to be safe and liquid. So possibly other countries, by issuing a CBDC, could capture some of that exorbitant privilege. Now, there have been concerns about CBDCs, and some of them, I think, are a little bit overemphasized. So one thing is that if the private sector has access to a CBDC that pays interest, then commercial banks would have to pay a higher interest rate in order to attract deposits. That, in turn, may lead to higher interest rates charged to businesses for loans or to households for home loans. But I think all of that is a little bit overblown, because the central bank could always offer a low enough rate on CBDCs to keep market interest rates low. It's also been argued that CBDCs could cut into bank profits. Some have argued, well, that's a good thing, that it's monopoly profits. But in any event, I think that is also something maybe that central banks could control by, in effect, subsidizing the private banking sector by offering higher rates of return on reserves. now, if the CBDC was issued as a zero interest rate deposit, that would, it's been argued, that would put a hard zero lower bound on the effective lower bound. Now, central banks can set interest rates a little bit below zero because of the cumbersomeness of holding large amounts of currency, but if there were zero interest central bank digital currencies, then it would be difficult or really impossible to push the interest rate below zero. But the main concern that's been raised about CBDCs is what would happen in a financial crisis. So it's been argued that there would be a run to safety to the central bank digital currency. Now, there have been counter-arguments to that. One is that central banks could lower the interest rate, possibly well below zero, although I think politically it would be difficult for central banks to be offering the public accounts with very negative interest rates. Alternatively, during a time of financial crisis, the central bank could simply limit inflows to the CBDCs. Or, you know, alternatively, if money is flowing into the CBDC, that could be recycled to the private banking sector through the discount window or other forms of loans. So it's been argued that that's not a conclusive argument against CBDCs. Now, here I would mention that this is an issue if the narrow bank takes the role of issuing these safe assets, because the narrow bank, privately owned narrow bank, doesn't have the same incentive for the stability of the financial system that central banks do. And I think this is kind of a major drawback to the narrow bank proposal. Finally, I would say that another issue is if it were the US dollar that was took the form of a CBDC, that I think there would be concern in the rest of the world that relies on dollar funding, because I think that the Fed would not necessarily have the financial health of other countries' banks in mind, and so they may be less active in protecting other banks during banks in other countries during a financial crisis. So let me conclude. Should a central bank create a CBDC? And I think it's up in the air. I would mention that I think that there will be an early mover advantage, that whoever first offers one would attract a lot of deposits from the world. They would have sort of their own exorbitant privilege, but being the first mover, they would also incur a lot of risks from the unknown aspects of the CBDC. And I'll stop here. So our first panelist is Tobias Adrian, who is the financial counselor and the director of the Monetary and Capital Markets Department of the IMF.
Great, thank you so much. Just a year ago, all the talk was about crypto assets, Bitcoins, and its multiple evolutions. And today, I'm going to shift and talk more about e-money. In particular, I'm going to focus on stable coins and how they relate to central bank digital currency and what it might mean for the international financial system. So I've written up my remarks in a kind of speech that is on the IMF website in case you want to go into a little bit more detail. So I'm going to broadly talk about e-money. And what I mean by e-money is that it's a means of payment and store of value that is fully backed by fiat currency. So it is the digital equivalent of a prepaid card, and there are many different forms of e-money. It could be in token form or in account form, and it could be centralized or decentralized. So one particular e-money that I'm going to focus on are stablecoins. So stablecoins are token-based coins that are fully backed by the fiat currency in some bank account so that they overcome a lot of the problems that Charles was pointing out about the crypto assets. So these are stable in value, and they can be used for transfer in the digital world basically for free. So the transaction costs are extremely low. So examples of e-money, so these are all different types of e-monies, for example, WeChat Pay and Alipay in China, M-Pesa in Kenya, Bitkom in the Caribbean, or the US dollar coin of Coinbase and Circle in the US. So for example, in Kenya, 90% of the population is using M-Pesa. In China, something like $18 trillion of e-money transactions have been done, which apparently is more than what Visa and MasterCard did combined. So e-money already has a big presence in some countries around the world, and there continues to be innovation in this area. So, as I said, the advantage of the e-money is that it's stable in value, so it doesn't have the Bitcoin problem where the value of your supposed coin is 3,000 one day and 6,000 the next day, or vice versa, which is worse. And of course, e-money is completely integrated into the digital life, right? To the extent that you are, probably the younger you are, the more your life is totally digital. And so e-money is integrated in you know, internet companies, basically. The transfer of e-money is near costless and immediate per construction. And in principle, because these are fully backed coins, there should be trust in these coins, right? There are network effects as well. In principle, size helps a lot in this marketplace. Of course, these are not riskless. There are lots and lots of risks. So at the IMF, we worry about all of the risks all the time. So the first one is that perhaps the e-money is not fully backed. There are incentive problems, as Charles pointed out. So, you know, as a company that is offering e-monies, you always have an incentive to under-collateralize your coin. And who is there to really check that all these funds are out there? Secondly, there's credit risk, right? I mean, presumably the issuer of the e-money also does some other business, and if that other business goes into bankruptcy, your collateral, your e-money collateral could be absorbed into these other parts of the bankruptcy proceedings. And thirdly, there are interoperability problems. You know, so it might well be that Charles and I were on the same platform and we can make payments, but Ahmed and I, we are using different platforms and we can't make payments. So how does interoperability work? Of course, within the traditional financial system, this has been solved, but in the new technology, this hasn't been solved. So one solution that you could propose, and here, this is where I move towards CBDC, is that, of course, central banks could come to the rescue. So they could solve all three problems that I pointed out. So number one, they could somehow certify that there are enough reserves. So imagine that there are stable coins or so, or some other e-money, where the reserves are not held by a private bank, but somehow either by a central bank or by a specialized intermediary that can hold reserves with the central bank. So at that point, such a specialized license could have a check on whether the money is fully backed. So that would solve problem number one. Problem number two was about the credit risks. So there could be some legal provision that basically whatever reserve you hold against your stable coin would be exempt, would be super senior in bankruptcy. So that's the second problem. And then the third problem about interoperability, well, this is core central banking business, is to ensure interoperability. So there could be in principle some standards that would make sure that Charles and I and Ahmed and I, we could all sort of like transfer these e-monies due to standard setting. So what I've described is a form of synthetic CBDC. It's not the pure CBDC that Charles described. So what I have in mind are some sort of stable coins where reserves that are fully backed by reserves, and those reserves either directly or through an intermediary, a specialized intermediary, are held with the central bank. So it's synthetic CBDC because the central bank is not involved in any of these businesses of actually running a coin. This is completely outsourced, but they do make sure that there's enough backing, enough reserves, and they do make sure that there's interoperability. All of the risk management, the KYC, AML, CFT problems, and the marketing, all of this is done by some companies. So de facto, this synthetic CBDC is a kind of public-private partnership in some sense. Now, this all sounds good in some sort of closed economy, but once we think about the open economy, this is becoming a lot more difficult. So even if it was the case that, say, in country A and country B, you could have stable coins where the reserves were held with the central bank or with an intermediary that was holding them at the central bank, you would still have the problem that if you wire money from one country to the next country, you would somehow have to readjust your reserves. And how do you do that? Well, there you're ending up with some sort of correspondent banking problem, right? Because now your reserves that are held with one central bank have to be transferred into the other central bank. And at that point, how do you verify that you have enough reserves in the right currency? Would you perhaps concentrate just on the major currencies and leave out smaller currencies? And would there be a counterparty credit risk because your foreign counterpart might not be under the same law and under the same regulations as the domestic counterpart when you're transacting across borders? So there are a host of issues about fragmentation, again, interoperability, correspondent banking, that are coming up. One particular risk that I want to point out, and this is true even for the stable coins that are present today, so even if stable coins are not backed by CBDC, is a higher risk of dollarization. So there's a natural bound to how much dollarization you can have in a given country, because typically transaction costs are high, and it's actually difficult in a foreign country to say transact in dollars or in euros or in renminbi or so. Once you go into this digital world, dollarization is a lot easier and is potentially a lot cheaper. And so this could undermine monetary policy in countries where there is a push towards dollarization. This is particularly a worry in countries with weak policy institutions, etc. And so what I've been talking about in a global context then are risks of fragmentation, of undermining the domestic monetary policy system, of international payments, fragmentation, weak institutions, etc. This is all like the bread and butter of what the IMF is about, right? And as a result, at the IMF, there is an increased effort to do surveillance on this particular topic, and there are requests for technical assistance on fintech and on CBDC in particular. So clearly the IMF can help in terms of its analytical capacity and its convening power. But if you think further into the future, if such sort of coins would become more important in some future monetary system, there surely will be further implications for the international monetary system. And some people have played around with the idea of digital SDRs or ESDRs, and whether there might be some role for SDRs that is different from the very, very confined role that SDRs have today. So certainly, wherever we go, monetary is going to become more important in the future, I believe, so that the International Monetary Fund, the monetary part of that, will probably be more prominent over the next 10 years than, say, over the past 10 years. With that, thank you.
So thanks very much, Tobias. That was really interesting. As you were saying before the conference started, I mean, a lot of the issues here revolve around the details of the design of a CBDC or a digital asset. So it'll be interesting to hear the thoughts of others that have investigated this. Our next speaker is Ahmed Al-Khalifa, who is the governor of the Saudi Arabian Monetary Authority.
Well, thank you. Good afternoon. Let me at the beginning thank the Swiss National Bank and the IMF for organizing this conference and for inviting me to speak in this panel. I have 4 points to mention about the IMS and the impact of technological changes and whether it will enable for the future of the IMS or the other way around. Let me start with the benefits and risks of the digital financial innovations, some of which were mentioned by Charles at the beginning. Therefore, I can be short. In addition to that, a lot of work has been done on this topic in the last 2 years, either by the FSB or the BIS or by the IMF as well. The key benefits for the digital finance or fintech are, of course, its potential to reduce inefficiencies in and the cost of financial innovation. The fintech can promote also financial inclusion by enlarging access to financial markets and services, and that is very important for developing countries. And we heard the case of Kenya with the M-Pesa. As for the key risks, of course, the cybersecurity, also alluded by Charles, the cyber security, also the consumer privacy, which is very important. And you know the countries are differing on the stage of protection of consumer privacy. Some are in advanced stage, others are lagging behind. The AML and safety is very important. And the last but not least, the financial stability. If one of the 3 conditions were to happen, one of them is the creation of new forms of credit and liquidity, which we are not aware of. Second is the undermining the business models, including the profitability as well, of the current financial actors, banks in particular. The third is the lack of alertness on the part of regulators and supervisors to address the implications of the fintech developments. Another implication could be the damage to the smooth functioning of the transmission mechanism of the monetary policy as we know it nowadays. If banks might be crowded out by the digital financial system, that makes more use of the so-called decentralized financial technologies and less use of traditional central bank money. The materialization of such risks would not only affect the national economies, but would also might weigh on the smooth function of the IMS. The question was put to the panelists whether the digital finance carries risk of more frequent or speedier crises. The short answer would be it depends. If trust in the new providers of the digital finance would break down, and as we know it nowadays, it could be, it's a high probability, and if the herd behavior would manifest itself more quickly, there would be indeed more risks and more frequent or speedier crises. I think history holds some valuable lessons here when you think about the circuit breakers to halt abrupt price movements in the stock market. One option to alleviate some of the risks, which is to have central banks step up their involvement in the digital finance, including by switching to the issuance of its own digital currency. If it's not the central banks that are issuing digital currencies, the field will be left open to the private issuers. My second point is about the potential for digital currencies. Can crypto assets become serious competitors for the currently used international currencies in general, and the US dollar in particular, and as a result accelerate the move to a multipolar IMS? The simple answer would be I see little prospect for any private issuer of a digital currency to be able to offer the same store of value or the unit of account features and the lender of last resort facilities as central bank that is issuing the international currency. Of course, one needs, however, to be careful, as technology has a track record of producing real game changes. Yet, I do not see in the foreseen future a case of complete substitution or competition, all the function of digital money with the central bank money as we know them nowadays. The third point about the use of fintech by the central banks. I have no doubt that this is likely to increase in the near future. We have our position in that. In Saudi Arabia, we have the economic plan, that's the Vision 2030. Underneath that vision, 12 programs. One of the programs is the Financial Sector Development Program. One of the objectives of this program is to build innovative financial infrastructure whereby digitalization will play a role. In this context, in the Saudi Arabia Monetary Authority, that is the Central Bank of Saudi Arabia, we have launched together with the Central Bank of the United Arab Emirates a project called ABER. Together with 6 commercial banks from both countries, we are conducting a proof of concept project using the DLT for both domestic and cross-border payments using common digital currency between the two central banks. The first use case of this project is to use the digital currency for payments between the two central banks, which will take place this month. The other use cases are payments between two local banks and commercial cross-border payments, which are planned for in July and August of this year. As cross-border payments today are mostly slow, costly, and relying on a correspondent banking network, we believe such new arrangements will help reduce counterparty risk, address inefficient liquidity management, and support the instant reconciliation of payment data. In addition to that, other objectives and benefits from the project ABER is to test the capability of the technology and to understand the concept of digital currency and explore the potential backup system for the current RTGS as we have it nowadays. The final point is about the implementation of a more digitalized global financial system for the global cooperation. My main message would be to plead for more international cooperation, first in the area of exchange of information, second in the domain of making common assessments of the risks involved, especially for monetary and financial stability, which is our area of responsibility. Any fragmentation in our approach might lead to the global financial system to lose some of the benefits that the digital innovations in the financial sector could bring about. If we succeed in harnessing our efforts, then the prevailing IMS will be able to adapt fairly smoothly to the challenges posed by an increasing digitalization of the financial sector, just as it has been able to cope with the previous large shocks. I would like to conclude by noting that the existing IMS is operating fairly well, but it has room for accommodating itself to the digital era, provided it remains dominated by coordinated efforts by central banks. Thank you.
Thank you, Ahmed. So you've touched on a lot of the major issues here, and you know, on the one hand, you point out that fintech can be used by central banks to increase the efficiency of the payment system. There are definitely issues on international cooperation, and actually a question that I think would be interesting to hear the people's comments on is whether the regulation of fintech is in some way fundamentally different than the problem that we've faced for a number of years of how to regulate the shadow banking system. Okay, our next speaker is Norman Chan, who's the Chief Executive of the Hong Kong Monetary Authority.
Thank you, Charles. First of all, let me thank Thomas and Christine for hosting this fantastic conference. It's very, very lively discussion, very, very fruitful. My comments really relate just to the CBDC. Charles gave a very useful overview, and Tobias, as usual, representing IMF, is many steps ahead of us. He's talking about synthetic CBDC. I'm a couple of steps behind, so I'll be just talking about the genuine CBDC as we know it. I would like to share with you our perspectives and views on these three issues. I don't think we have all the answers. It's too early to give the answers, but I want to share with you some observations on three issues. HKM has been very active. There's lots of excitement in Asia, at least, for central banks to be getting into this study research together with private sector technology companies into CBDC. We've been part of it, but these are kind of interim views on this issue. The first one, will CBDC displace conventional currencies? We talk about banknotes. And the second question, is CBDC just a technological innovation? You probably heard the speakers, probably not. And where does CBDC have the most promising prospects? I think the mixed views, and this is something which is a contentious issue. I think more work, more debate will be needed on this one. The first question, in terms of comparing with central bank currencies, central bank issue currencies, we're really comparing with physical banknotes, right? The physical one you use to pay and pay people. But in that sense, I think our view is that a digital CBDC, however designed, would only offer very limited benefits in terms of retail payment for domestic system. Why? Because in many countries, in Hong Kong, for example, the e-wallet, the digital payment, faster payment scheme would enable individuals to make payments in domestic currency in split seconds. The difference would be 1 second compared with 3 seconds. So in terms of a digitalized CBDC, compared with banknote, yes, tremendous advantage. Compared with other electronic form or digital form payment, we think that the benefits will be limited. And if you wish to design a retail system that is available to all the people on the streets, then the system, the scalability, the speed is a technological challenge in doing that. For large value, as we know, corporates use bank balances, bank liabilities to transfer, and is usually very efficient. And therefore, again, the benefits will be quite incremental. Now, the issue just been highlighted by some speakers is a lot of issue that on AML, CFT, investor protection, consumer protection, that need to be looked into. Because in banknotes, you can't conduct compliance check unless you get somebody on the spot and you ask questions. But for freely transferable CBDC at the retail level, you can't really do ex-ante compliance. Whereas in the banking system, the institution will be somehow accountable to the money they send through the system. They have to know the KYC, they have to do CDD, they have to report suspicious transaction to the law enforcement agency. But of course, post-events, after transfer, something goes wrong, I suppose the law enforcement authorities will be able to trace easier than banknotes. Banknotes, you can't simply trace them. So this is important AML safety implications that need to be addressed. I know that in some central banks, the research project is actually undertaken by the FinTech technology department. And I think it would be a mistake to do that, because it is not just a technological project. It has wide implications for monetary policy and banking stability. I think this has been highlighted. I just talk about the technological challenge. If you want to have a decentralized distributed system for all the retail public, then the system will be gigantic. The technological challenge in doing an efficient payment system will be very enormous. But how about liquidity risk? In good times, normal times, it's okay because public corporates have confidence in the banks. They're quite happy to use bank balances to make the usual transaction. But in case of stress or a financial crisis, the switch from commercial bank balances in CBDC could pose great risk to banks in terms of liquidity and even solvency. Some talk about can we not restrict issuance, the supply of CBDC? Yeah, I'm supposed you can do that. You have power to do that. But once you do that, when there's a high demand from the society, then you have differential pricing. CBDC would command a higher price than commercial bank balances. So you don't have a one-for-one kind of conversion. The monetary policy transmission mechanism will also be affected to the extent that if the public prefer to hold a sizable amount of CBDC as compared to commercial bank balances or commercial bank liabilities, the banks will have a small ability to create credit, and that will also have an impact on monetary transmission mechanism. The most promising prospect to me is not the retail, not the domestic RTGS, but cross-border. I think we all know, I think the current system is highly inefficient, highly costly. For those of you who have the experience of banking a check sent by somebody from the United States to Hong Kong, let's say Switzerland, a US dollar check, it would take 14 days if you're lucky, and maybe $50 to actually present it. It's a nightmare. For small value cross-border payments, I think it impedes on financial inclusion. Small guys, SMEs, find it hard. Big corporates, $100 million, no problem, good service, real time. But otherwise, the service is very, very limited. And we don't have really good solution for that. And I think the e-wallet operators, in some cases, have presented some cross-border remittances, highly efficient, very low cost. But going forward, I think the CBDC, I've talked about, CBDC issued by central banks, would have a lot of benefits that can be presented in cross-border payments, both for large value as well as small value. Small value because it's convenient, large value because it's remove counterparty risk. But of course, you have a situation in which at the moment the regimes in the world depend heavily on institutions, intermediaries to do their checking, enforcement. You hold them accountable for wrongful remittances, transfers, but in a decentralized system, who will be doing that? I think this is a big issue that we need to address. Let me conclude. There's a little clock here, in case you don't know, that's the enforcement tool, Charles, for panelists to behave. I think CBDC have certain prospects, but central banks need to be proactive in either one of the two ways, or both ways. Tobias talked about a synthetic CBDC. Lunchtime, we talk about a private sector operated digital wallet with backing, with fiat money backing, is stable coins, safe assets. If that's the approach for private sector to take a lead, but those issues are just highlighted, AML, cross-border, CFT, safe custody of the collaterals or the float need to be developed. We just can't let private sector to do everything on their own. What if people lose the money? They can't get the money back if the company go bust, just like banks. And therefore, I think central banks have a responsibility to think of some regime that could actually give sufficient protection to consumers and users of these digital currencies. The second approach, which is the one I talk about, is central bank actually issuing CBDC. I'm glad Tobias talked about this e-SDRs. I have the same thought. Clearly, dollar will be the kind of a candidate that people would use, private sector especially, to facilitate cross-border payments and transactions. But for people who really want to have stable bilateral exchange rate pair, a basket or SDR type would be an ideal candidate. But the same question, who would be the issuer? Who would be the trusted counterparty or central party to keep custody of those afloat will be an important issue. But the conclusion is that if the central banks or the authorities don't take a proactive step, I think the private sector will be miles ahead. And they are already doing a lot without, I think, an appropriate regulatory regime in place. I better stop here. Thank you.
Thank you very much, Norman. So that's, I think, a really nice way to put it, that a lot of times central banks' research has concluded that the CBDC is a really risky undertaking for a central bank, but you highlight that it's risky not to issue a CBDC as well, because then you've left it to the private sector, and then you need to worry about the regulation of the private sector. But now we have someone from the private sector, Brad Garlinghouse, who is the CEO of the financial technology company Ripple.
I will start off by also thanking Charles, thanking Thomas, thanking Christine. It's an honor to be included. And as was introduced, I think they saved me for last so that I could talk about the private sector version of this. I also start by kind of explaining the basics of what Ripple is and what Ripple is not. Ripple is a private company. We're based in California, about 300 or 400 employees around the world. And we're trying to solve a problem. We're selling technologies to banks and financial institutions to solve a cross-border payments problem. To be clear, we have not focused on the central bank digital currency issuance. Our view is very much there needs to be interoperability globally. And even in a world of CBDCs, you still need interoperability to solve that problem. Also, before I dive in, my comments are more focused on kind of explaining how Ripple's approaching this problem as opposed to just CBDCs. But I thought it worth spending a moment on how we think about blockchain at large and why it is such an interesting technology and I think appropriate for central banks and commercial banks to be looking at. For me, the novelty of any blockchain technology is the ability for two parties to transact without trust, but with certainty. So today, anytime we transact, we are transacting through a central counterparty, whether that be a correspondent bank where Ripple is focused, or that be a Visa or American Express, what have you. The opportunity around blockchains is to change that dynamic, and I think many industries, whether it's payments, what we're talking about today, or securities, or even loans, any of those transactions, I think, can be disrupted and made more efficient through blockchain technologies. All right, so with that kind of brief introduction, I'll be brief on some of my comments here because we've touched on this already. I think we would largely have few arguments with the idea that global payments today have not caught up with the age of the internet. We talk about slow. We've talked about the 14 days that Norman mentioned. The younger generations today are accustomed to be able to open up their smartphone and click on a button and have an ice cream delivered in 20 minutes. They aren't going to be very happy when it takes their payments, days and lots of costs to get to them. Another thing that is, I think, often lost upon us is the opaqueness in the problems with which correspondent banking currently operates. There's a 6% error rate self-published that 6% of all SWIFT transactions require human intervention. Now, that doesn't mean they don't get there. It just means that human intervention adds time, it adds cost, and what have you. And lastly, when we talk about cost, it isn't just about transaction fees. It's also about the pre-funding required for commercial banks and even large corporations and the cost of that capital. What's amazing to me is that these costs are often borne or burdened the populations that are least able to afford them. Data from the IMF and the World Bank would say that the average remittance costs around 600 basis points in a world where we think about the internet enabling kind of real-time instant information. Why can't we use these new technologies to build an internet of value? When we look at the current dynamic I was just talking about, the pre-funding, if the correspondent banking network requires this pre-funding, I'm not talking about a central bank level, but as much as I'm talking about it at a commercial level. And oftentimes, even when I'm meeting with senior people at various banks or financial institutions, they'll talk about their cost to fund into the Mexican peso, and they'll cite a very, very low number. But what that doesn't include is the cost of capital that's sitting at a bank there. It also restricts competition because it requires capital to get it there. Our view in the future is you don't have to have this pre-funding, and instead you can use a digital asset to have global liquidity on demand. Now, we build upon a tech stack of an open source technology called XRP. XRP originally was built by some engineers who had seen some of the flaws of Bitcoin and the challenges of scalability around Bitcoin. Where Bitcoin today, on a per transaction basis, it's rather slow and rather expensive. XRP is very, very fast, about 1,000 times faster per transaction and 1,000 times cheaper per transaction. The other dynamic, of course, of correspondent banking is some of the more quote-unquote exotic currencies, exotic corridors have been left to kind of stand on their own. And the liquidity in digital assets could be applied to actually make that much more democratized and a level playing field. Ripple's vision from the beginning really has been to apply these technologies in the same way that TCP/IP and HTTP are the technologies underpinning the Internet of Information. These blockchain technologies will be the underpinnings of an Internet of Value, where we have connected devices, we have connected information that will allow payments to flow. And as Norman was describing, if you're a large corporation moving $100 million, that's one thing. If you're a freelancer working in the Philippines doing design work for a company in London and you want to get paid $30 or 30 pesos, Philippine pesos, that's not a transaction that can easily be enabled. And in fact, for the companies that enable that, they require the freelancer to set up an account and they don't actually pay it out until there's roughly 1,000 USD sitting in that account, and then they would pay it out. So Ripple has come to the market with 3 products, and I will just briefly touch on them. The first one is called XCurrent, and the reason why I'll point this out is because XCurrent doesn't touch crypto. XCurrent is just kind of Swift 2.0. It's a messaging framework that is much more efficient and real-time as compared to fiat to fiat. That typically is how we start working with any bank or any financial institution, is on a fiat to fiat basis. The bottom product we see down here is called XRapid, and XRapid is really where we use XRP to fund real-time liquidity. We brought this product to market in Q4 of last year, and immediately we saw the demand for that type of product from banks, financial institutions who want to open up new corridors for payments, but don't want to open up new nostro-vostro relationships and the friction and overhead that goes with that. The third product is really simply an API that allows corporates to do real-time payouts into this network we call RippleNet. The challenge here, as many of you may know, is there's corporations ranging from Uber to Amazon to less technically efficient companies. They employ hundreds of engineers that just integrate into payment networks around the world. They're building custom APIs into payment networks in the Philippines or Indonesia, into the Middle East, what have you, so they can enable those payouts. We think by standardizing on an open source API, we can make that more efficient for everyone. We've been fortunate, and actually, I meant to say up front, I had a very good conversation before we started this panel. One of the things I worry about when we talk about blockchain technologies is sometimes they are a solution in search of a problem instead of a problem in search of a solution. There's many times when people come and talk to me about blockchain solutions, and I ask them, why can't we just use a database? Why is a blockchain a better solution? And in Silicon Valley, where I've been for 22 years, sometimes it's catnip for investors. It's just to get investors excited, where a database would be more efficient. Now, the reason why I offer these remarks at the beginning of this slide is I think one of the reasons why Ripple has done well is we've been very focused on solving a specific problem for a specific customer, and we've been focused on that for a long time. And we've been fortunate, therefore, to get about 200 customers globally now working with us in one way or another. So I'll conclude just by saying I think the excitement around blockchain is well-founded, and it will impact many, many industries in the same way the Internet of Information 20 years ago has impacted many, many industries. But I also think sometimes that the hype gets ahead of the reality, and we need to be clear about what problems we're trying to solve, whether it's at a central bank level, a commercial bank level, or in other industries altogether. With that, I will turn it back to you, Charles.
Thanks very much, Brad. Well, I'd like to hear more about that. It certainly sounds promising, and I think we'd all like to know more about how counterparty risk is avoided here and the problems of foreign exchange liquidity. And I think that's a conversation that will continue. But I think next I'll open the floor to questions. So, Augustin.
Thank you very much. Very brief reactions to some very rich panel. First, with respect to your introductory remarks, Charles, something that for me just didn't sink in very well is this idea that CBDC could be an easy source of financing for the government. I mean, in most central banks, a first no-no is to finance governments. And I think one of the issues of CBDCs that has been, especially depending on the shape, is that it might crowd out the transactional deposit base of banks, which are efficient at intermediation. Now, the question is, well, CBDC might disintermediate banks. That's some serious concern, but then disintermediate them to finance the government, that's even more difficult. So that's a first issue I found. Then, you know, we need to think very careful about what should motivate our progress in this area. And I subscribe a little bit what Brad said. Oftentimes we're looking for a problem to use some technologies. It sounds a little bit to me that that's your proposal, Tobias. I mean, I think that at least the issues you plan to address pretty much all have been solved without making, for example, central banks from being issuers to being the auditors of wallets, no? That's in a way what you want us to make now in terms of certifying that the backing is there fully. I think those problems have been solved, are solvable. Right now, through two-tier system, open to many participants, not only banks, can give pretty much all these solutions without majorly affecting the way central banks operate. Even I think the problem that Norman is thinking about can be solved, not necessarily issuing central bank digital currency. So my point is, and when I speak later, I will talk more about this, but I think, yes, we should be very open to technology, but first we need to think about the economics, if it really makes economic sense to move forward in that respect. Thank you.
Okay, let me take Thomas Jordan, and I have a couple of others, but maybe let's hear from you, and then we'll get some responses.
Well, thank you, Charles, and thank you very much for these excellent presentations. I have two remarks and two questions related to these remarks. The first to Charles. Well, you made a very good introduction, and the key really is who should have access to central bank money. This is the key question. And in that respect, it's really what is the role of the state and the central bank in that sense? Should we provide a means of payment, a safe, stable means of payment, a unit of account, or is our role to provide an unlimited safe asset to everybody? And this is a huge distinction. And if the second is our role, then we may end up really with the ultimate holder of risk. If in a certain situation, everybody wants to have, as a counterparty risk, the central bank, then we have to provide all those safe assets. So I think the really fundamental question is, what is our role? Is it more a safe means of payment, stable, or is it really that we should provide everybody unlimited with a safe asset? And then, but maybe you could comment, Charles, on that point. And the second one for Tobias, in your description about these stable coins, what actually is the difference between, in an economic term, not in a technological term, between a bank deposit and a stable account? A stable coin is more or less the same, and that would also, in a way, implicate when we start from the principle, same activity, same regulation, that in fact, at the end, we should have a very similar regulation regarding these stable coins as we have already now for bank deposits.
Well, why don't you go ahead and go first?
Okay, so three things. So I think it's important to look at the whole world, and you know, a large part of the population in the world doesn't have access to bank accounts, and even if it does have access to bank accounts, those are extremely expensive. It's expensive to make payments, wirements, international payments. So I think one of the big motivations for this new technology, right, because Agustin is asking why, is that there's huge financial exclusion, and these technologies have proven to increase financial inclusion enormously. So I think you have to look broadly around the world. I think this is one motivation, and I think the Ripple example is one example, and Norman has talked about that, is that international payments are very expensive, and the structure is not very well built. Secondly, about the synthetic CBDC, and I just learned this morning that you actually have a special purpose license in Switzerland where fintech institutions, as far as I understand, can deposit money with a central bank. And in principle, I think that goes a long way to create something pretty close to the synthetic CBDC, where by synthetic CBDC I mean that you have a digital currency that is deposited with central bank money. Of course, there are other trust issues that I talked about that need to be solved, and they're, to make this as safe as true CBDC, there are bankruptcy issues, there are lots of issues. So, it's not that easy, and the devil is in the detail in all of this. But I think that given this special purpose license, you're actually pretty close to being able to do this in Switzerland. Thirdly, I mean, is there a problem to be solved? I think the world is moving to becoming more digital. I mean, the way that we are transacting today is very different from the way we transacted 20 years ago. And I think in 10 years, we will just interact in very different ways. And I think at some point people will say, cash, I mean, why could you ever have had cash? It's a very weird instrument when you think about it. If we were today debating, should we introduce cash? I mean, it's not obvious that you would actually want to do that. It has many, many shortcomings. Whereas I think, there is a digital revolution underway, and I think it's very natural to think about what that means for money. And of course, I mean, in systems such as the European Union, where you have instant, pretty much costless transactions, retail size, you don't have to solve many of these problems. I completely agree, and it's in the broader world that I think many of these motivations come from.
I want to quickly answer the question that Augustin posed to me, but I'm going to turn the one Thomas posed to me over to Norman Chan. But when I said it would save governments money, I wasn't suggesting that great, we can start creating money and finance yourself. I just meant it saved us money in the same way that an open market, it saved government money in the same way that an open market operation does, that the interest paid on reserves is lower than the interest on treasury bonds, and that was all I meant by that bullet point. But I'd like Norman to address the question of should central banks be only offering a stable currency, or should they also offer a safe asset? And Hong Kong's had a stable currency for many years.
Yeah. Can I, before I comment on that, I think we must distinguish the debate between whether you have, let's say, physical currency, banknotes for transaction as digital means of payment. I don't think the debate's about whether it's physical banknotes versus digital. The world is going digital. The issue is whether the central bank should step in to actually be more proactive to, let's say, compete in some way with e-wallet operators. E-wallet operators are very efficient now, and many banks are also very efficient in making retail payment in split second, as I said. So it's totally digitalized. So there's no problem with that, about efficiency, speed, and cost. The problem is whether in cross-border context, you need to depend on bank liabilities to make the transfer. And you have a lot of issues about inefficiency, layers, corresponding banking. Brett talked about this opaqueness, take a long time, financial exclusion. But whether CBDC using DLT would provide a better answer? That's the question I'm talking about. I think there's a lot of prospect in that, but it doesn't mean it can be achieved tomorrow, both technologically and also regulatory regime. If the private sector continue to move ahead, they'll be ahead of us. I don't think there's a kind of regulatory regime that is designed to oversee the kind of stable coins transfer system. Do you regulate them as banks, you talk about? Maybe, maybe not. And who is going to ensure the public, the float, the backing is actually there when they redeem, right? We as supervisors would actually ensure banks, we have the money there to pay back with depositors. But how about these private sector issuers? So the question is really about whether central banks should do more, either collaborating with private sector to facilitate them to move ahead in a kind of a more controlled and safer manner, or central banks should just step in and say, look, we, central bank, would do the issuance using DLT, overcoming those problems we talk about in cross-border payments. Safe assets, I don't know, it's a hard debate because if the public suddenly say, I have lost confidence in the banking system, I want to withdraw my balances with banks with bank notes, would you deny that? So the question, do you really have control over the amount of issuance in the central bank liabilities? In good time, you say, I'm going to deal with banks. But in bad times, do you have the choice? I know bank notes are very cumbersome, expensive to store. But in case of stress, the public may say, I want bank notes. I trust nobody but the central banks. And that control is probably, I suppose, is very, very tentative.
Okay, I've got Governor Olson and Barry Eichengreen.
Okay. Well, Øystein Olsen, Norges Bank. Well, my question or comment perhaps was very much related to those of both Augustine and Thomas. It was triggered by your intervention, Tobias. All very interesting. The future is difficult, the complex with the technology. But my question is really, you talked about the e-money. I take it that you refer to some kind of new providers of e-money because, I mean, as already mentioned, it's not about cash. We have most of our transaction now is in terms of digital money, based on when we draw on bank accounts, and you know, my money as a concept is a strange thing. I think most people think that when they think it over. Fiat money, ordinary fiat money, are created when credit is given, and I guess when I think about this, what's really important, especially on the role of central banks. It's about confidence. It's about trust and confidence to the value of money, and to the existence, to the concept of money and the monetary system. So. I'm not at all an expert on the technology. The technology is new. There are new possibilities there. But to some extent, I feel that when we discuss the structure and the role of the central bank, it may be that a history repeats itself, and it's really about whether you should have a decentralized system of money providers, or whether the central bank should have the same central role as it has had. Thanks.
So we're running a bit short on time. I've got Barry Eichengreen and Dirk Niepel. So let me collect those questions, and then we'll see where we stand.
So I have a quick observation and a question. Last year, I had a fellowship at the Bank of England for a month, and I had to pay my rent in advance. It cost me $10 and took me 24 hours to transfer the money from Bank of England to Santander UK. So I'm not going to tell you what the platform was. You know what my banks are. The problems with that transaction were that the money was uninsured for the 24 hours that it was in transit. And $10 may still be a lot of money for the Philippine copy editor, but I think there's a tendency to overstate the gravity of the problem. The question, and Brad, this is an honest question. Ripple is, one of your products is to distribute liquidity through the payments system. So the question is, could there be a run on Ripple? In other words, everybody wants your liquidity. Nobody wants to provide it because there is a scenario where people develop doubts for good reasons or bad about the system.
So let me first clarify what Ripple provides. Ripple doesn't provide liquidity. Ripple provides technologies that allow you to access liquidity that exists in the marketplace. In the last 24 hours, the digital asset marketplace traded about $50 billion of liquidity in 24 hours. That includes XRP, but that includes Bitcoin and Ether and what have you. So, could there be a run on digital assets at large? Just the nuance of the question is, Ripple sells technologies. Can there be a run on Ripple? I don't know what that looks like. I mean, I can't really think about that. Could there be a run on digital assets? I don't know. I mean, today again, $50 billion of liquidity, and people are moving liquidity around. For XRP, a settlement happens in 3 seconds. And so, to your point of taking 24 hours, I mean, 24 hours that's a positive story of a cross-border transaction. Many take longer. So taking a 3-second transaction and the risk associated with a 3-second transaction as compared to a day or 2 or 3, I think most people would say, hey, I feel better about taking 3 seconds of risk than a day or 2. So could there be a run on digital assets? Even that, I don't know exactly how to think about, because again, there's a lot of, I suppose at $50 billion a day in a nascent, I view it as a pretty nascent market today. And people are getting liquidity that exists in the marketplace in local regions between XRP and the Philippine peso, XRP and the Argentine peso, XRP and the Brazilian real, and it's tapping into that liquidity that exists in the marketplace.
Let me take Dirk Niepelt's question as the last one because we're slightly past time here.
Thank you, Charles, and thanks for mentioning the Reserves for All. So Dirk Niepelt, Study Center Gelsenkirchen and University of Bern. I want to offer one comment on this notion that is very frequently voiced, that CBDC would undermine financial stability, and I think I would like to argue that the opposite is actually the case. And there's an accounting part to the argument, and there's an economic part to the argument. The accounting argument is simply what is happening if somebody wishes to transfer funds from a bank account into CBDC. What is happening is that the central bank acquires a claim vis-à-vis the banking system as the counterparty of that transaction. So that means that the banking system doesn't lose any funding, it simply changes the composition of its funding. So you might argue this has consequences, it certainly has, but there's no notion of funding breaking away from the banking system as a response to an expansion of CBDC. And the economic argument is that on top of that, what is happening in the process is that the central bank is gaining importance as a creditor of the banking system, which has, of course, many implications. But on the financial stability side, probably it has positive implications. Rather than having many small depositors, what you would have is one large creditor. And this large creditor is internalizing run externalities, and it's much likely to run. And the system is much more stable as a consequence. So all in all, the financial stability argument, I think, is very much overstated. On the other hand, and that comes back to what Thomas said before, of course, the question is, do we want the central bank to take a bigger stance and a bigger role in the banking system? Do we want that? And there's many political economy arguments that would lead you to say, no, we probably don't want to do that. But all I want to say here and point out is that the financial stability argument, I think, is a non-starter if you want to discuss CBDC. Thanks.
Well, I think we need to wrap up. Let me just see if anyone has any final comments. And they're distributing sweets and coffee, so everyone should be in a better mood. But let's see if would anyone like to add anything? Okay.
I reserve the argument on this financial stability point because for us, if we swap, I will deduct the balance, the reserve that the bank holds with us. That will actually lead to a shrinkage of the balance sheet of the banks. So I'm not going to hold the commercial bank claims on my balance sheet. You see what I mean? So there's a point of contention. We'll have a bilateral discussion afterwards.
So I would just add to Governor Olsen's question about confidence and trust. So I think we are in a period of technological disruption, and it's difficult to see exactly how the financial system is going to look like in 5 or 10 years. But clearly, central banks have a role of guarding financial stability, and to the extent that we do see in many countries that these e-monies are coming and that all kinds of innovation is taking place, I think that inexorably there will be some role for central banks in there. And I think it's particularly in the countries where these e-monies have a huge market share that the central banks are particularly concerned.
Okay, great. Thanks very much.